All right, so we're going to look at, this chapter is mostly kind of a reading comprehension chapter. So I'm going to give you some highlights and some videos, short videos to kind of keep up. But this one will go fairly quickly, and I think nicely ties into a lot of what Allison is talking about. So, conflicts of interest. So this is a hot topic right now with our President Trump. What has been some conflict of interest concerns with President Trump? Yes?
But he hasn't, well, one of the conflicts of interest that he hasn't gave rights of his company over.
Okay. So why would that be a conflict? Somebody other than Eric?
Could implement policies that would be beneficial to his company.
Okay, good, yeah. So pass laws, regulations that benefit maybe just real estate companies in general, real estate holdings. So this has been hotly debated with Trump, and it's complex with his particular case. So does anybody, I don't know if you guys have followed this or not, do you know what Trump has done? Did he sell his properties? He did not. So he didn't sell all his properties. What has he done?
He limited the blind trust.
Yeah, he kind of made it so that he has no direct operating control any longer in his companies, but he still has an ownership interest. So how is that fair? And so then there's been these, and I don't know all the details of this, the ins and outs, just from what I've gathered from various news sources. There are certain laws on the books that say presidents must, I can't remember, it was a funny word that I never really obscure themselves, or something about can't have this conflict of interest in a certain way. But his attorneys, as well as other attorneys that don't have a dog in the hunt for Trump himself, have said that he can do this kind of blind trust thing, and that's kind of good enough. While other people are saying, no, he should really sell all his interests. As somebody who has not even, I had about 32 limited liability companies and or S-corps when I came to Ottawa University. And I went through a process of selling out my shares to my partners in different ways. I had really one main partner, but that took like a year and a half. For my little measly, it was about 150 units of different sorts, and there was a little bit of commercial property, a little bit of operating interest in some operating entities, but I mean, relatively speaking, a drop of water in the bucket compared to what Trump's dealing with. Not let alone that Trump's value of his assets, I don't know where that's at, but he is a billionaire. So we're talking about dollar values. If he was to sell his interest or be forced to sell his interest, who's going to buy it except at a fire sale price, right? Imagine just the marketing time alone could easily be 4 years for him to market all of his interests, to sell it all and get it all figured out. It took me, like I said, about a year and a half, because it's just so, it's hard to explain all the details, but there's lots of little moving parts and things to take into consideration. And, oh, I don't think that's right for this particular thing, and, whatever. So after 4 years, his presidency's done anyway. So, is it reasonable even to ask him to do all that? Well, it looks like he's holding on to it. So the conflict of interest will remain there. I mean, I don't think it's fair to say there is no conflict of interest, period. That's kind of hard to argue in Trump's case. So the question might be kind of a cost-benefit analysis is there really anything there? An interesting argument I heard a commentator make was he didn't think there was much if any of a conflict of interest, because what Trump really makes his money on now is his name. And so he has incentives to keep his name pure, if you will, or a good name during his presidency. So if he comes out of this presidency, whether he wins or loses after 4 years, or if it ends up being 8 years, if he preserves the integrity of the Trump name, he will have won. You see what I mean? So it doesn't really, passing some laws or regulations that might have a little bit of benefit to him or something, he doesn't even have incentive to go that way if it would, help him unduly. It would be really short-sighted, since what he really makes his money on is the Trump name. So I thought that was an interesting insight in regard to conflict of interest, that maybe we're getting worked up about nothing anyway. And then I've heard where the line potentially could be crossed is that he's got foreign dignitaries coming to DC for meetings or whatever, and they're staying at the Trump Hotel in DC. Again, he's benefited. Yeah, he's not in the operations, but they're staying at his hotel. So now are those Chinese diplomats purposely picking the Trump Hotel so that they can say, hey, I stayed at your hotel, it's really nice, and whatever. You can't escape it, right? So it's an interesting area, and definitely a very complex application of conflict of interest. So these are good things to work through and think of here. All right. So any other comments or questions on the Trump example? Okay. So what is a conflict of interest? A conflict of interest is a type of moral hazard. A type of moral hazard that occurs when a person or institution, has multiple objectives. And as a result, conflicts between them. So pretty easy in Trump's case. Back to the Trump, one of his objectives is to maximize profit for his real estate portfolio, his real estate holdings. Now Trump also has an obligation under oath, being sworn into office, to maximize the welfare of the United States. So those would be the two objectives that might come into conflict in some way, shape, or form. All right, so there might be some bad outcomes that can have, but we want to think about what's the benefits. Where can we have benefits come from these multiple objectives? And this brings up a term you learned in principles class: economies of scope. Good. Scale's in there too, but I think economies of scope is especially relevant. Who remembers what economies of scope is? There's economies of scale, which is one we probably spend a little bit more time on. Not all of you have had intermediate micro, but we kind of spend time on both there. But
Ability to use one resource for multiple.
one resource for multiple
Events, I guess.
Yeah, events or things, right? Multiple production, so multiple products is typically how we see it applied in a business. By using resources for multiple products, what's the advantage that we hope to get? Save resources, and I want to be a little bit more specific. If you're saving resources, you are being more efficient, I like that. Cutting costs, yes, that's the one I was looking for, because it's always related to cost with economies of scope and scale. So economies of scope, if we did it kind of mathematically, I think this is just kind of easier to think about it this way, but maybe it's just because I'm weird. The cost of making product 1 plus the cost of making product 2 in its own standalone facility is greater than jointly producing goods 1 and 2. So if you produced good number 1 all by itself in a standalone building, you kind of looked at the whole thing, management, people, labor, all the resources, and then you had another plant that produced good 2, and it did its own thing. By jointly making them, we have lower cost. That's the idea of economies of scope. So lower cost by doing more. All right, so more tightly connected to this chapter, since we're on investment finance topics, this is economies of scope is realized by what in terms of what we talk about in this class? Where would we see economies of scope? Who does economies of scope? And where it might end up being conflicts of interest. What are some multi-products that go on that are really more relevant for this class and for the Allison book matter?
Banks.
Banks, yeah, like what? Give me some things. Yes, for sure. What's the product that the bank provides?
Credit.
Credit, okay, so they're issuing loans. What else? Somebody else jump in besides Matt. What else do they do? So they give loans, they have loan products. What else do banks do? Think about what they offer. Come deposit your money with me because I offer loan products and what else?
Could this be like Wells Fargo?
Yeah.
The Wells Fargo problem?
And what are you saying?
Like the conflict of interest of having to make new accounts on behalf of consumers, even though they didn't sign up for it, but they have the power because they have the information.
Okay. So yeah, so Wells Fargo got into trouble doing some of their multiple accounts. So there's multiple types of accounts. We've got loans. What else? So give me another thing that they do, a service that they offer.
Certificates of deposit.
Yes, so they have different types of products that way. So investment products, they offer investment products. Savings accounts. So CDs, savings accounts, different types of ways to invest your money. They also advise clients, right? So they offer advice. I think you should do this, I think you should do this. Now, when they offer advice, are they likely to suggest that you go put your money in Vanguard? No, they're going to probably steer you to a Wells Fargo product, right? So that's part of the conflict of interest, is that they're treating you more like a customer than what we call a client. And so this was one of the regulations that, you remember when Max Brewer came, my former student, that this was a big one. They were thinking about creating some restrictions and or regulations about the type of advice companies could give on whether they were steering them into their products or not. So in real estate, we kind of called it client level service versus customer level service. So in theory, a client level service is a higher level of service where I, as your agent, have your best interest at heart. Not the heart of my company, but you. And so that's the angle that a lot of independent brokers take. You guys are probably familiar with some insurance brokers at your homes where you live, right? There's the State Farm office, and then there's Joe Blow Insurance that deals with all kinds of companies. Right? Are you familiar with that in the insurance game? You with me? So you've got an independent agent. And so they just, like one that we dealt with was Nap Tedesco Insurance or whatever. It's usually the last name of the original proprietor. That's maybe been around even for 100 years. He's long dead. Somebody else has taken over his business. So that is an approach to mitigate the conflict of interest because they have access to other products besides their own products. Now, truth be told, in a lot of those situations, if they steer you into a Goldman Sachs product versus the Vanguard product, Goldman Sachs gives them a 3% commission, Vanguard gives them a 1% commission. So even under that setup, you got to be careful about what the compensation plans are. They still might have incentive to steer you into certain products. All right, so in our banking industry here, we've got economies of scope realized by providing multiple financial services. Multiple financial services to customers. This is exactly what we were talking about with not doing too good. Trying to get myself a little room set up, sure, but in the Allison chapter, what were we talking about that this relates to? It's one of our topics today. What was the banks that went down and morphed over in the 70s? Yeah, though they ultimately busted the savings and loans. They were restricted to making only home loans. So they were a special entity that said, hey, we want to specialize in customer service, and people put their money on savings with us, and then we loan it back out to them. Savings and loan. It's kind of a special carve-out. But they were restricted in what they could do. They couldn't do commercial loans. In fact, another example is credit unions. Prior to about 7 years ago or 8 years ago, credit unions were not able to make commercial loans. So they could not offer a loan to somebody wanting to start a business somewhere, some sort of commercial loan. And so we've continued to allow economies of scope to occur by reducing regulations, saying, it's okay, Goldman Sachs, you want to take on deposits? Sure, right? Or Wells Fargo, you want to get into investment banking? Sure. We used to not let you do that. You kind of had your own little game you played, and the investment bankers over here. But if there's enough economies of scope, we'll keep the costs down for the consumer. So it might be in the consumer's interest to have multiple companies competing with each other by allowing them to offer multiple financial products. Okay, questions on that? How about economies of scale? How does that differ? Economies of scale. Scale economies. It has to deal with costs going down again, but how are we reducing costs? Increasing the amount we produce or the quantity. So this is reductions in cost, long-run costs, by increasing volume. So this is reduction in long-run costs by increasing the volume of business. Okay, so we start to see banks getting bigger and bigger. We've gone from 12,000 banks down to currently we have about 6,000 banks. So there's kind of a move of bigger and bigger banks, hopefully not too big to fail, right? Because then we got, but when do we reach that point of them getting too big? So those are kind of the two benefits that we have. And so we have a reduction in costs due to economies of scale. We have a reduction in costs due to economies of scale. So both of these things are arguments for allowing these things to happen. Conflicts of interest would be working against it. All right. Let's see. Let's do a little reading. Let's shake things up a little bit today. So, I think most, if not all of you, have had Professor Wagner as a accounting professor. And do you know where she worked in the real world? Anybody know? She probably mentioned it, but it might not be a detail you paid attention to. I don't know about that one. But she worked for Arthur Andersen, the company we're looking at in the scandal. Hopefully Professor Wagner was not a part of the scandal. I don't think she was, but I wouldn't put it past her. No, just kidding. Just kidding, Lynn, if you're watching this later. That's just a joke. You know it is. Okay. So, just so I'm not talking the whole time, let's kind of read this one out loud. Let's see. Chisholm number between 4 and 8. 1, 2, 3, 4, 5, 6, 7. Zach. So it goes Zach, Jacob, and Kimmy. There's only 3 paragraphs, so.
Okay. In 1913, Arthur Andersen, a young accountant who has announced and slips on his set of good practices that enabled his investing public, founded his own firm. In the early 1980s, auditing was the most important source of profits. In the late 1980s, however, the consulting part of the business began to experience high revenue growth with high profit margin, even as the audit profits slumped into a more competitive market. Consulting partners began to assume more power within the firm and resulted in confidence in the firm. Arthur Andersen, the auditing service, and Andersen Consulting were established as separate companies in 2000. During a period of increasing conflict with Andersen's audit partners had faced growing pressure to focus on boosting revenue and profits from audit services. Many of Arthur Andersen's clients that later went bust, Enron, WorldCom, West, and Global Crossing, were also the largest clients in Arthur Andersen's regional offices. The combination of intense pressure to generate revenue and profits from auditing and the fact that some clients dominated the business of regional offices translated into tremendous incentives for regional office managers to provide audit stances to these large clients. The loss of a client such as Enron or WorldCom has been devastating for a regional office and partners, even if that client contributed only a small fraction of the overall revenue and profits for Arthur Andersen as a whole.
The Houston office of Arthur Andersen, for example, ignored many problems in Enron's reporting. Arthur Andersen was indicted in March 2002 and then convicted in June 2002 for obstruction of justice for impeding SEC investigation of the Enron collapse. The conviction was overturned by the Supreme Court in May 2005. Its conviction, the first ever against a major accounting firm, barred Arthur Andersen from conducting audits of publicly traded firms and so effectively put it out of business.
Okay, so let's start with what's the 2 products that it got into over time? Auditing and consulting, right? So the consulting started being a profit area, and they started to get more and more benefits of getting into this consulting area. That's fine. Their business could have built up nicely. How did that then trickle into some unusual pressures in the next paragraph. What did they start finding themselves doing?
Trying to make more money in audit.
Yeah, so kind of, and how did they, I think more money was one thing, but not necessarily, that wasn't all of it. What were the pressures that they were facing? Trying to keep the clients, these big clients that were doing good, right? Now, not all of you have had advanced accounting, but some of you have. You know who you are. Explain for somebody what, just in general, what's an audit? Explain, if you do an independent audit, what does that mean? Who wants to take that? I heard a vote for Chisholm. Do I have a second? Oh, a second and a third? Okay, Chisholm. What is an audit? In the simplest of terms, yeah, whatever.
It's just like going in and making sure you're doing it right.
Yeah. And you take that class next semester, fair enough. So here's how it works. The company has their own accountants, right? They work for Enron or they work for the company. They keep track of the books. And then periodically, depending on your company, there could be quarterly, semi-annually, maybe even annually, you have an independent third-party audit. And this might be required by your lenders or your shareholders. If you're a publicly traded company, your shareholders want to know if you're cooking the books or not. So they go to Arthur Andersen, one of the most reputable accounting firms in the world, and they have Chisholm to their company physically. They usually have to put her up in a hotel room for maybe 2 to 3 days, and she is poring over all of the accounting records and saying, and not looking at every single detail. She might be randomly pulling some files in different departments, but she's double checking, did they do their debits and credits right, basically? And how did they treat this particular area? And then she comes back, usually Chisholm would say, well, you were okay here, I thought you should have maybe taken it this direction, but I find no material evidence that these books are wrong, and you kind of give it the little blessing. So you get the Arthur Andersen Chisholm blessing on the books, and then that gets published to the shareholders or the banker that says, hey, Arthur Andersen checked us out, our accounting procedures are following GAAP. The generalized accounting, generally accepted accounting principles. So we're following GAAP guidelines. So that's the idea of an audit. Now, what can you be creative with? There's actually turns out to be a lot of creative elements in accounting. But when you're looking at profits, we've got total revenue minus total cost equals profit in the most simple economics 101 fashion. Where does all this come from that makes life kind of interesting with accounting? Where's some fudgeable things? Total cost, how so?
Like, for example, at a laundromat, rate payments still laundered cost.
Okay, in that particular example, Jacob, let me run with you on that. I probably would have to take that to the fraud level. No, I want to run with you because the fraud level's fine too. So you have a machine that's not really broken. So you hire Joe Blow Fix-It Place, which is actually a company you own 50% of along with your brother-in-law. Joe Blow Fix-It Place comes, the bill is $1,000 to repair the machine. The machine's not really broken. If we're talking fraud area, they came and polished it off. They actually showed up with the truck for a little bit of evidence, and they pulled out their tool belt, and maybe they unscrewed the back panel, but they didn't do squat, and you cut a check for $1,000, paid it to Joe Blow. That's where we get into fraud areas. That happens all the time. So that's one area that gets monitored is, and if you're that company, you want, your manager might have made the call to Joe Blow Fix-It. Are they stealing from you? Right? So that's how theft at the accounting level can happen, which would inflate total costs, drop profits. So that's one area that you have, that auditing happens like, hey, this is kind of looking a little bit funny. That could be one area. What other areas could there be some funny stuff going on? Yeah.
Categorizing their revenues.
Good, and that's a huge one with these Enron cases. So the classic one I remember from Enron is they get a promise to pay basically an accounts receivable of some sort of contract that they got for $16 billion, and they would book that as revenue when maybe it either could have been a gray area, maybe it was a new innovation of a certain product, or it shouldn't have been done at all. It should have been booked as a revenue. So all of a sudden we're to the good 16 billion on accounts receivable that we don't know will happen or not. Now this does in fact go on because if this is 2015 and we booked this revenue, but then this revenue never came through, then you lose it in 2016. And so now we're down 60. We take it out of revenues the next period. So this is one of the things that goes on with accounting also between revenues and or costs can be kind of passed along from one year to the next. Depending on the tax situation with other elements, you might find it beneficial to shift expenses into 2016. How do you do that? Well, it's pretty simple, really. If you have an expense that came in 2015 and you have the invoice sitting there on December 16th, you could pay it right now, or if it's a 30-day pay period, you could, and being still in good graces with your vendor, you could pay it January 7th. Right? If you pay it January 7th, the total cost shows up on these books. If you pay it in December, it shows up on these books. And that's totally legit. I mean, all companies go through, that's not fraudulent at all. That's just the timing of expenditures. But it is a way that you can slightly tilt the books possibly one way or the other with the timing of your expenses. Now, if you're doing an accrual-based accounting, then that doesn't matter with accounts payable, accounts receivable will flow through at the time it's made. But on a cash-based accounting, which is what most small businesses do, then you can time those expenses over time periods. You're scowling, is that not true? Or did I say, and I might say stuff that's not true, so feel free to call me on that. Okay, Eric.
Were the executives also like Enron, like taking money for themselves and is that like putting it as something else or like as an expense?
I think in some of those cases, I can't remember if it was WorldCom or Enron. Yeah, they were padding pockets to some degree, but executive bonuses was another big one. So if you have your bonus structure, it might be possible for you to shift that revenue into this year where you're going to get paid a bigger bonus because of the circumstances. Maybe the costs were low, and so you shift all into this time period so that you get a big fat bonus. And then next year we shift the cost over here, and then this is a loser year, and you don't get as big of a bonus. So executive compensation is another thing that gets played around with. All of that, because of all these scandals, I hope a lot of that's kind of closely monitored now. That you wouldn't think another Enron's going to happen. But as we move through time and regulations change or pressures, new things come, you never know what might be around the corner. Okay, any other questions there? All right. So the three things that we're going to look at in this chapter that also get talked about in the Allison book, Sarbanes-Oxley, Dodd-Frank, which we already talked about in the previous chapter, that's going to be brought up again here. So Dodd-Frank regulation, which was 2010. So that's the one that is kind of on the hot seat right now. Sarbanes-Oxley was 2002, and then the Global Legal Settlement Act, which was the 2002 passed, which was partly due to some of this WorldCom Enron. All right, let's end a little bit early today. Mark your calendars. If you didn't see this chapter's due dates are this Sunday, so start working on homework or whatever you can. Yeah.
I don't know if you want to screenshot
Just something that's critical. You're in it now, or you take it now? Yeah, whatever you can give me that shows you're registered for it, and then I'll just send it off to the registrar's office, and then we'll see what they say if they want more information. I'll just pick it up later. Okay. Oh, yeah. What did you want to look at? Oh, Zach, I'm about to look at that sheet if you want to see it.
Yeah, I do.
Hey,
Wait up.
are you coming with me?
Well, I need that stuff to the damage. I'm gonna post it, by the way. I'm just really excited to see it. On the SLC. Well, this is. I believe this is it. Good job.
Alex and I won't be here on Friday again, so.
Ball game. Can do.
Same time.
Yeah, and then yeah, you'll miss the tail end of this.